Brad Williams, Frugal Finance. Let's talk about European bond options. We now explore the application of the black model to European bond options. A bond option is simply an option with a bond as the underlying good. For example, the underlying good might be a treasury bond or note. Applying the black model to value an option on a bond presents three complications. First, the input price, T, the model should be the forward price of the bond. Second, the application of the model must account for accrued interest in any coupon payment between the valuation date and the expiration date of the option. Third, the input volatility should be the volatility of the forward bond price. We consider each of these issues as follows. The forward price of the bond. In applying the black model to futures, this is not a particular problem because the future price is immediately observable and is closely analogous to a forward price anyway. For a typical bond, there is no quoted forward price. Therefore, application of the black model to value options on bonds must address the issue of finding the forward price of the underlying bond. We could find the forward price of the bond by looking to the term structure of the interest rates. There are a number of ways of dealing with this tricky problem. First, we could use the zero coupon yield curve to value the bond as of the expiration date of the option. Second, we could take the term structure of interest rates between the present date and the expiration date of the option using the term structure of interest rates between the present date and the expiration date of the option. If the bond pays any coupon payments between the valuation date of the option and the option's expiration, we'll have to take this into account. Accrued interest and coupon payments. Bond prices are typically quoted without accrued interest. To apply the black model successfully, we need to focus on the actual cash flows that are at stake. Therefore, if the bond price is quoted without accrued interest, we'll have to take the accruals into account. When the underlying bond is a coupon bond, there will likely be coupon payments between the time the option is being valued and the option expiration. This will affect the estimation of the forward price of the underlying good. The situation is really analogous to pricing an option on a dividend-paying stock. Payments of intervening dividends on a stock or intervening coupons on a bond both represent a leakage of value from the underlying good that must be considered. If we use the term structure to value the bond as of the expiration date of the option, we can ignore the intervening coupon payments. However, if we use the present price of the bond and compound it forward to the expiration date of the option to find the forward bond price, we will need to reduce the present price of the bond by the present value of the intervening coupon. This adjusted bond price, the current cash price of the bond minus the present value of any intervening coupon payments, can be compounded to the expiration date of the options to find the forward price of the bond. These two techniques should give exactly the same price. The input volatility. The correct volatility for the model is the volatility of the forward bond price. Like the forward price of the bond, the volatility of the forward price is not immediately observable. It will require estimation. Usually, data on bond yields are available, and we can use bond yield volatility to estimate the volatility of the forward bond price by considering how the forward bond price would respond to a change in yields. That bond yield can be used to estimate the volatility of the forward bond price. Brad Williams, Frugal Finance. More to come. Thanks for watching.